Long before the ringing bell on Wall Street, people were traders. This is a fundamental truth, folks. Think about it. Thousands of years ago, there were no dollars, no euros, no fancy digital currencies. If you were a farmer and had more grain than you could eat, but you needed a new tool, what did you do? You found someone who made tools and had too many. You traded your grain for their hammer. This was the original market. It was a simple, direct exchange of goods and services. People bartered, they negotiated, and they made deals face to face. This is where it all began, with the basic human need to get something you don't have. This system of bartering was great, but it had its limits. What if the toolmaker didn't need your grain? What if he wanted wool instead? You would have to find a shepherd, trade your grain for wool, and then go back to the toolmaker. It got complicated, fast. So people started using things like shells, beads, or precious metals as a common form of payment. This was the invention of money. Money made trading much, much easier. It allowed markets to grow bigger and connect more people over larger distances. This was a huge step forward, a real game changer for commerce. Now let's fast forward a bit. As civilizations grew in places like ancient Rome, so did the complexity of business. The Romans had ideas that look a lot like modern business. They had partnerships and contracts. Groups of investors called societates would pool their money together to fund big projects like shipping ventures or construction contracts. They would share in the profits or the losses of the venture. While you couldn't trade your piece of the partnership on an open market, this was the seed of an idea. It was the beginning of thinking about business ownership as something that could be divided and shared. This concept of shared risk and shared reward is absolutely critical. It's the bedrock of everything we talk about on Mad Money. The Romans understood that big projects needed big money, often more than one person could provide. By pooling resources, they could take on bigger risks for the chance of bigger rewards. They created legal frameworks to manage these agreements. This laid the groundwork for the more formal systems that would come later. It proved that when people put their capital together, they can achieve incredible things. That's a lesson that is just as true today on the Nasdaq as it was in the Roman Forum. Now we get to the real action. Let's go to the Netherlands in the 1600s. The Dutch were the kings of global trade. Their ships sailed everywhere, bringing back spices, silks, and treasures from the Far East. These voyages were incredibly expensive and incredibly risky. A ship could be lost at sea to a storm or pirates. No single merchant wanted to bet their entire fortune on one trip. This is where the genius idea comes in. This is the moment that changed everything. The Dutch East India Company, or the VOC, was born in 1602. It was a mega corporation for its time. The VOC needed a tremendous amount of money to build ships, hire sailors, and fund its long voyages. So, what did they do? They did something revolutionary. Instead of just getting a few rich partners, they opened up investment to the general public. They sold paper certificates called shares. Each share represented a tiny piece of ownership in the company. If you bought a share, you were a part owner. You were entitled to a piece of the profits the company made from its spice trade. This was the first publicly traded company in history. It was a monster idea. This created a brand new problem, a good problem. People who owned these shares might want to sell them. Maybe they needed the cash, or maybe they thought the price was going to go down. Other people might want to buy shares because they believed the company was going to make a fortune. To handle all this buying and selling, the world's first stock exchange was established in Amsterdam. It was a physical place where buyers and sellers could meet to trade their shares. The price of a share would go up or down based on supply and demand, news about the company's voyages, and pure speculation. This was the birth of the stock market as we know it. For the first time, you didn't have to be a wealthy merchant to invest in a big business. A regular citizen, a baker or a blacksmith, could buy a share and have a stake in global trade. It was the democratization of finance, the very beginning of it. The Amsterdam Stock Exchange created concepts we still use today, like futures and options. It showed the world how to raise massive amounts of capital to fund innovation and expansion. The Dutch gave us the blueprint, and believe me, the rest of the world was paying very close attention. Booyah! The Dutch had a brilliant idea, but the British were ready to take it and run with it. London was becoming the new center of the financial universe. Ambitious traders and businessmen gathered in the city's coffee houses on Change Alley. These weren't fancy offices, they were loud, smoky rooms filled with energy. This is where they traded stocks in companies looking to follow the Dutch model. They were funding everything from trading companies to schemes to pull treasure from sunken ships. It was wild, it was chaotic, and it was the beginning of the London Stock Exchange. This early market in London was like the Wild West. There wasn't much regulation, and that led to some big problems. The most famous was the South Sea Bubble in 1720. The South Sea Company had a monopoly on trade with South America. Everybody got excited, and the stock price went through the roof. People sold their homes and their life savings to buy in, but it was all hype. The company had very little real profit, and when the bubble burst, the stock price crashed to almost nothing. Fortunes were wiped out. It was a painful lesson that taught the importance of real value over speculative frenzy. Meanwhile, across the Atlantic, a new nation was being born. The United States needed money to grow. In 1792, 24 stockbrokers and merchants met under a buttonwood tree on a street in New York City. That street was named Wall Street. They signed the Buttonwood Agreement, promising to trade only with each other and to charge a standard commission. This was the humble beginning of the New York Stock Exchange, NYSE. They were trading the very first U.S. government bonds and shares in the first American banks. They were building the financial engine for a new country. As America grew, so did its stock market. The Industrial Revolution was a massive tailwind. Companies building railroads, steel mills, and factories needed huge amounts of capital. They sold stock to the public on the NYSE to raise that money. The stock market became the place where the dreams of entrepreneurs met the savings of ordinary people. It fueled the incredible growth that turned the United States into an economic powerhouse. From a small meeting under a tree, the NYSE grew into the biggest, most powerful stock exchange in the world. It became the symbol of capitalism and opportunity. The 20th century was a roller coaster for the stock market. The Roaring Twenties saw a massive bull market where everyone seemed to be getting rich. But it ended in the Great Crash of 1929. The market collapse was devastating. It wiped out investors and was a major cause of the Great Depression. This event was a brutal wake-up call. It showed that markets needed rules to protect people. In response, the U.S. government created the Securities and Exchange Commission, the SEC. The SEC's job is to be the referee, to ensure fair play, and to make sure companies tell the truth about their business. After the Great Depression, the market slowly recovered and began a long period of growth. But it wasn't a straight line up. There were other crashes like Black Monday in 1987 when the market dropped over 22% in a single day. Then came the dot-com bubble burst in 2000, when internet stocks that were all hype and no profit came crashing down. And we can't forget the financial crisis of 2008, which was another massive shock to the system. Each of these events was scary, and people lost money. But each time, the market learned, adapted, and eventually came back stronger. Now look where we are today, in 2025. The stock market is completely different from those old coffee houses or even the trading floors of the 1980s. The biggest change is technology. You don't need to call a broker in a fancy suit anymore. You can buy and sell stocks from anywhere in the world using your smartphone. High-speed computers make millions of trades in fractions of a second. Information that used to be only for Wall Street insiders is now available to everyone online. The market is faster, more accessible, and more global than ever before in history. It's a whole new ballgame. So, why should you care about all this? Because the stock market is not just for the rich. It's for you. It's one of the most powerful tools for building wealth over the long term. When you buy a stock, you are buying a piece of a company's future success. Companies use the money you invest to grow, innovate, and create jobs. Your retirement account, like a 401k, is probably invested in the stock market. The market's health affects the entire economy. Understanding its history, the booms, the busts, and the lessons learned, helps you be a smarter, more confident investor. Now go out there and do your homework.